Hey Prashant, thanks for joining me today. How's everything going? Everything well?
Actually, yeah, really good, thank you. How have you been? All good?
Perfect. Very, very well indeed. I'm really excited for today's podcast, actually, because we're going to be discussing the ins and outs of, taxes. Now, we all know that taxes have changed recently. So, specifically, that corporation tax currently has now gone up to 25%. And it'd be nice to hear your thoughts around ultimately, is it still worthwhile purchasing property in a limited company versus a personal name? What's the best thing to do there? And what are the considerations to think about when people are doing that? Does that make sense?
Yeah, definitely does. Yeah, you're quite right. Corporation tax rates have gone up. The first £50,000 will still be taxed at 19%, depending on how many companies you have. Any profits above £50,000 will be taxed at 25%. So unfortunately, yeah, corporation tax rates have gone up.
Well, that's useful to know first of all, because because people say, "Oh, corporation tax has gone up," but actually, what you're saying is, for the vast majority of people who own properties in their limited companies, certainly they own the kind of properties that we buy in the north, their incomes probably won't be more than 50 grand. So actually, when this thing's not really going to affect them, is that right?
That's correct. The only other consideration is if they have more than one company and the structure is the same shareholder, same directors, then you effectively divide that £50,000 by the number of companies. So if you have a trading business and you have an
Yeah,
investment property company, that £50,000 gets split into two, so it's £25,000
and so let's
to generate 25k profit.
Yeah, so what you're saying is, like, for example, in my case, me and my wife own, for example, a property company that owns properties, and then we also own this trading company, Lifestyle Property People. And so what you're saying is that because we both own those two in the same structure, as in are both 50-50 shareholders of both, that £50,000 will be divided by two to 20, and it will become £25,000 is the limit rather than 50. Is that what you're saying?
Correct. So after £25,000, that's when you'll pay 25% tax.
Interesting. And what if you're making significantly more profit in one of those businesses rather than the other? Because let's say that yeah. Does that make sense? Does it make a difference?
It doesn't. It's still just divisible by the number of companies you have.
Fair enough. Okay, that's I suppose that's the easy way to implement it from the government's point of view.
Yeah, definitely. It's
Yeah.
this is how it used to be actually about 10 years ago.
Oh, okay.
Then they scrapped it, made it a fixed rate, and we've come back to it obviously because of COVID and all these other issues we're having around the world.
So it used to be like that. Then they made it easy for everyone, and then they were like, "Oh, do you know what? It's too easy. We want to make everyone's life a bit more complicated, and we'll go back to this old system." Okay, fine. So ultimately, the question that we get asked all the time, Prashant, and you know this because we send clients to you, we refer clients to you so they can get the tax advice about this, is should I buy in my personal name or should I buy in a limited company? And most people tend to have this kind of belief that, certainly because most of our clients are from London or live outside of the country, that they should be buying a limited company. Is that always the case? And what kind of things should they be thinking about?
Look, I'd say majority of the time, in my opinion, from the clients that we see, it is better to structure through a limited company. Look, the benefits of going through a limited company are it's still a lower, it most likely still a lower rate of tax.
Could you let's just unpack these? So most likely it's still a lower rate of tax. Can you give us some numbers on that so we can understand it?
Yeah, so corporation tax up to the £50,000 limit is 19%. The
Cool.
lowest rate of personal tax is 20%. So there's a 1% saving there. Now, most people who go down this route are probably higher rate taxpayers through their employed work already. So
Yeah.
to do it in your own name, you will instantly pay tax at 40% on any rental profits.
Yeah.
To make matters worse, if you buy in your own name, you can only claim 20% tax relief on your mortgage interest, whereas through the limited company, obviously we can expense all of the mortgage interest.
Right. Yeah.
That
Yeah.
that makes quite a big difference. I mean, as an example, if there was rental profit of say just under £10,000, you're probably going to pay around two to £2,400 less, roughly.
Oh, okay. Okay. So
It's
it's
quite a big
considerable.
save if you're a high rate taxpayer, that is.
Yeah. And that obviously that notion that you've just given us there, that usually for the kind of clients that we work with makes sense for them to buy a limited company. That is on the basis that both the parties, because usually we have, say, husband and wife or business partners, that both the parties are high rate taxpayers. what if that's not the case? What if one is and one isn't? Because, I know that we can buy, and we sometimes tell our clients that they can do this, is buy in tenancy in common rather than joint tenancy.
Well, if that was the case, let's say you have a husband and wife. Let's say the wife is a higher rate taxpayer and the husband's only earning, say, £15,000
Yeah.
Per annum. Obviously, he will still have a lot of income he can utilize at 20%. So up to £50,000. So there's another 35k there. However, a lot of people who do invest in property, it's usually for generational wealth. It's something to pass down. Of course, it generates extra income.
Yeah.
But it's usually to pass down to your children, your grandchildren, etc. Now, if you buy it in your own name, obviously it falls within your estate when you pass away. If you buy through a limited company, it will still form part of your estate, but there's a bit more planning that can be done around that.
Right. So, I mean, going back to this idea of buying it in your own name, I think what you're saying is that if you are looking to draw the money out and use the money, the cash, the profits, that's a different scenario to if you're looking to just keep it in the company and then ultimately just give the company to your kids, or give the company to your kids.
Correct. I mean, look, if you buy in your own name, rental profit is taxed at 20, 40 or 45%, whatever tax bracket you're in. If you do it to a limited company, it'll be taxed at either 19 or 25%. Now, it's entirely up to you whether you extract any profits as dividend. You don't have to. You can leave it all in the company. I mean, look, there's other ways you can look to reduce your corporation tax bill as well. You could potentially invest some of that money put it into a pension pot. You'll get tax relief on that. There's still a government initiative to purchase electric cars. You get tax relief on electric cars. The initiative is meant to be around until 2025. My personal opinion is they'll extend it because I don't think there's enough electric cars on the road, and that's what they're trying to do.
Okay, hold on. So you're touching on the sexy stuff now, Prash, right? So let's talk about cars, because that's the thing that interests me, and I'm sure a lot of the people that are listening to this will be thinking to themselves, basically, I need to upgrade my car. I think what you're saying is, well, if instead of spending the money buying the car or whatever, why don't I buy a property, make profit, and then if I do it within a limited company, there's a way that I can effectively expense the car in the limited company or something like that. Is that right?
That's correct. We've got clients who have done that. They've purchased an electric vehicle through their investment property company. And obviously, you'll get tax relief on the whole car.
Yeah.
The only thing is there's a 2% benefit in kind charge, which is not a lot. Obviously, you're going to get 19% tax relief.
Yeah.
You're going to get a nice new shiny car.
Yeah.
And that's one criteria. It has to be a new car. You can't go and buy a second-hand car.
Yeah.
And yeah, it's a big bonus.
Well, and I suppose the other thing that you could do is you could just lease the car rather than buying it outright.
You probably would look to lease the car.
Yeah. Okay. Fine. Because obviously leasing the car, then you'd get your 19% tax relief on that. And actually, what I realized the other day, because I didn't think about this before when I bought my last car, and then I started adding up the costs, and I was like, oh my god, it's actually a massive saving. So the monthly payments is something that you can put through the company, but as well as the monthly payments, you can put your insurance through the company. You can also put your servicing through the company, your MOT and all that kind of stuff. So basically, you can put any of the costs that are to do with the car through the company, and that could easily be, depending on which car you drive, between £500 and £1,000 a month, easily.
You can even put your electricity through the company, and even the charging point that you install at home.
Yeah. Okay.
But obviously, it's all subject to the 2% benefit, but like I said, 2% is not a lot.
Well, I think what you're saying is, if I'm saving 19%, the fact that I have to pay 2% is not really that big a deal.
Yeah. Well, and how it works actually is 2% of the value of the car, and then you get taxed on that amount, 2% of the value of the car,
right?
The tax rate is. So if it's 20%, it's 20% of.
Can we just do some calculations to help people understand exactly what we mean, right? So let's say, for example, we've got £50,000 car, right? Because most of the electric cars these days are around that kind of, a decent spec is about that kind of value. So if I do that £50,000 car, and you're saying it's 2% of that, right? So 0.02 multiplied by 50,000 equals £1,000.
Yeah.
So that's how much tax I've got to pay. Is that right?
That's effectively the income that you have to pay tax on. So then if the tax rate is 20%, you pay 20% of 1,000, or if you're 40%, you pay 40% of 1,000.
So wait, hold on a second. So if you're saying, let's just assume we're 40% taxpayers. What you're saying is that if I'm a 40% taxpayer and I buy that brand new car for £50,000, then I'll pay £400.
Yeah.
I pay £400 and I get a 50 grand car.
Yeah, but obviously you're not paying £50,000. You're leasing the car for probably £400 a month.
Well, I mean, you could do either or, right? What you're saying is I could buy it as well.
You could buy it if you wanted to buy it outright, but then obviously you have to inject more money into the company, which
Sure, yeah, but director's loan, and then I can always draw that out afterwards. I mean, obviously, lease versus buy a car is very similar to like, do I buy the property in cash or do I buy the property with a mortgage or whatever? So I think that's personal preference. But the point is, whichever way you do it, whether you lease or you buy it, you are effectively getting this car that is worth 50 grand or whatever for 400 quid. That's how much you've got to put in from ultimately your own pocket. And this is what I mean by the sexy stuff that people don't consider when they're, yes, we're trying to grow our wealth, and yes, we're trying to invest in properties, but there are these little side tricks that we can do which would really boost the value of the investment, because now we're not just talking about getting a 5-7% yield on a property. We're talking about getting a 5-7% yield on a property within a limited company, that we can also get a 30 grand a 50 grand electric car for 400 quid.
yeah, exactly.
Amazing.
There's other expenses as well that aren't so sexy, like relevant life insurance.
Okay.
Everybody should have life insurance if they have a mortgage.
Yeah.
Obviously, you can put it through the company and you'll get tax relief on that as well.
Brilliant. And actually, I just did a podcast with somebody else last week about relevant life insurance. So if you are listening to this and you want to know more about that, then definitely go into our podcast history and you'll find it there. But what you're basically saying, Prash, is that a lot of people will be putting life insurance through, like they'll be paying for it personally. But what they can do now is they can pay for it through the company, because what we're saying is that instead of me paying it after tax money, I'm paying it before tax money. So I'm making a saving of 19%. Is that? No, actually, I'm making a saving of 40%, because if I'm a 40% taxpayer, I would have had to pay 40% to get that money into my own name and then pay for the relevant life insurance that way, isn't it?
Yeah, exactly. So you want to do it obviously pre-tax.
Yeah.
And it's a better way to pay for your relevant life insurance.
Brilliant. So far we've got the company car, which is amazing, and then we've got the relevant life insurance. What other kind of things what other benefits are there of investing through a limited company rather than doing it through the personal route?
So there's also, like I said, there's the pensions.
Yeah.
Pensions are a great place to put your money. Obviously, there's different levels of risk.
Yeah.
Low. We obviously don't sell pensions as accountants, but
Yeah.
there's good tax breaks there.
Yeah. And what you're saying there is, so a lot of our clients, we were just discussing, are usually a couple who are professionals. So they work in whether it's an accountancy firm or a bank or whatever, some firm, but through that firm they get workplace pensions. And they don't really think about it ever since, because they're like, there's my workplace pension. I don't really get to see it. It just goes into my pension. But what you're saying is that this way, through the company, they could top up that pension or a pension, and it could mean that they have more in the future. But the real advantage of this, again, going back to this pre-tax position, is you can pay for that before tax, before you actually take the money.
Yeah, exactly. And I think a lot of people see pensions as, oh, I'll get it when I'm old.
Yeah.
The thing with private pensions versus state pension is, with current legislation, you can access 25% of it tax-free when you're 55. You can start drawing it down when you're 55. Whether that changes to 56, 57, that's still relatively young.
Yeah.
Obviously, state pension, 67, 68, yes, will be that much older, but private pensions, you can tap into them early, and you don't know what they could be worth.
Yeah, because we were discussing actually that what most people like to do is they say, well, here's my pension and the stock market stuff on this side, and then here's my property investment on this side, and they kind of keep those two things separate. And what I mean by separate is they say, well, the stock market stuff is going into funds and stocks and that kind of thing, and it's always going to be there. And the property, the money that I put into property, any profit that I make from property, I just want to take that money and reinvest it into property. But what you're saying is, if they do it through a limited company, they could take that profit that they're making and ultimately put it into the pension, put it into this side over here, because it's more tax efficient to do that.
Yeah, exactly.
Yeah, amazing.
Look, other small benefits. There was a £2,000 dividend allowance that's now reduced to 1,000. Next year it's going to reduce further to 500. We don't know what will happen beyond that.
Yeah,
but it is something to factor in. I know it's a small perk, but it's still a perk.
Yeah. Yeah, good. And so obviously we're talking about whether to buy in limited company or in personal name, and we should do it for the right reasons, not just the perks. We were previously talking about inheritance and the fact that the reason why most people buy these properties is not necessarily for them to use the money themselves, because it's only, say, for example, 3 or 4 or 5 thousand pounds a year. So it's per property, it's not a huge amount of money. But the reason why we're doing it is because over, say, a period of 20, 30, 40 years, these properties are going to generate a significant amount of income, and also be a lot more, they'll grow in value over time. So what they're really doing is they're doing it basically for their kids. And I'm sure a lot of people listening to this podcast will relate to that. So with regards to doing it for your kids, how does it work with regards to doing it in your personal name, or doing it in company? Why is one better than the other? So let's just take one way and let's work through that, and then we'll take the other way.
So my actually knowledge is limited, but I know enough. So if you do it in your own name, the portfolio forms part of your estate. Now, everybody has a nil rate band of £325,000. If you're married, that's 650. If you are going to be passing down your main residence where you live, you get an extra £350,000 basically. So £1 million will be tax free.
Yeah.
You have to kind of think the way property prices are going. Let's say me and you, Shiv, when we are no longer here, what's our main residence going to be worth? It may not be worth £1 million just yet, or yours might be, but by the time we get there, it probably will.
Yeah. And I think that probably for most of our clients, that's the case. It's like, it may be worth £1 million already, or it may be, you know, in the region of £800,000 right now, but it will by the time, you know, the next 10 years.
Now, if you purchase in your own name, there's little you can do. Like I said, it forms part of your estate, whatever your portfolio is worth, whatever your total portfolio less any mortgages you have, that will go into your estate. Now, down the limited company route, once your children are of age, so 18 years old, you could look to freeze the value of your shares. You effectively create another class of shares. So you have A shares and B shares.
Yeah.
You will freeze the value of your shares, so it's capped. So you will still pay inheritance tax, but at least you're capping it.
Okay, hold on. So what? I want to just reiterate that, because that's a really good point. What you're saying is, let's say, for example, I've got kids that are 16 years old right now. You're saying I buy the property and I buy it for £150,000, for example, and in the next 2 years it goes up to £180,000. So I've made a £30,000 gain. But then, because they're now 18, I can then cap my gain at 30,000, and then do some jiggery pokery at your end to give them some shareholding, so that effectively all the future gain in the property is in their name rather than in my name. Is that right?
Yeah, that's correct.
Wow.
Pretty much the gist of it. And obviously that reduces what will go into your IHT, but because the likelihood isn't, you as parents, you go before your children.
Yeah.
That's why you'd go down that route. And hopefully for most people it does go that way.
Yeah, amazing. Okay, so that sounds really good. What would happen in your personal name? So let's say I have properties in my personal name, then what happens?
It usually just form part of your estate. If you sold to your children, there'll be capital gains tax, there'll be stamp duty. You can't just transfer property, you can't gift property to your children. You will incur capital gains tax immediately. It's not like gifting a business. Property rules are very different to business rules.
Oh, right. Okay. So, and I think this is the thing about trading businesses versus investment businesses ultimately, right? They're different. But what you're saying is, so if I own a property right now, and imagine that over my lifetime I managed to, or own 5 properties, and over my lifetime I managed to pay those properties down, so there's no mortgage on any of them, but they're in my personal name. You're saying that when I die, then I'm going to have a big problem, because no doubt by that point I'll have a residential house worth more than £1 million, or net assets worth more than £1 million, plus the property portfolio, which means that essentially I'll have to pay 40% inheritance tax on the property portfolio, more or less.
That's correct. And a lot of people think it's as straightforward as saying, oh, why don't I just transfer into a limited company?
Yeah.
You can't do that, because there'll be stamp duty taxes. You effectively have to sell it to a limited company.
Yeah.
Look, there's businesses out there, firms or tax advisors, who will try to do it. I've been involved in the past. I know HMRC are kind of questioning all these schemes as well. So this is why it's so important to plan earlier. And the advice at the moment is it's limited company.
And I suppose the point is, right now, there's no need to go into the detail of everything, because everyone's personal circumstances will be completely different. And actually, what you're saying, we're trying to give them the top line, so that people look at this and go, yeah, you know what, I probably should go and get some advice. I think the problem that the challenge with that a lot of clients get into is they say, yes, I'll buy the property. They end up buying the property, and then they think about the tax advice. And by that point, obviously, it's too late. And as part of our service, as you know, what we do is the first thing that we do is we say, let's go and get the tax advice before we even set up the company or anything like that. What should we do? So we refer the clients to you. You help them out with that situation. And in order to help them out, like, what information would you need to know from them in order to help make that decision?
So we usually ask for their personal situation, what their income is, and also what their ambition is, because that's quite important to know. Look, they could come to me and say, do you know what, Prash, I'm actually looking to move home myself.
Yeah.
And I need the extra income to boost my
Right.
personal mortgage. Now, that's a circumstance where maybe you want to go down purchasing in your own name because all the profits will be allocated to you. As it boosts your income on your SA 302.
Yeah. Your tax return, SA 302.
Yeah, exactly. On tax return. On the flip side, you can still go down the limited company route and just extract everything as a dividend.
Yeah.
Of course, some brokers may want to see 2 years of two tax returns. But that's typically what we'd want to know from them. And then it's a case of, look, if you're looking to do this to just keep reinvesting and grow your portfolio, and if you're already a higher rate taxpayer, it just makes more sense. It's more tax efficient to go down the limited company route. But again, it's all subject to individual needs.
Yeah, okay. So it's subject to individual needs, but the rule of thumb is if you are a high rate taxpayer and if you're doing it in a partnership, if you're both high rate taxpayers, then it makes more sense to do it in a limited company because there's a whole bunch of benefits doing it that way. And if you are not both high rate taxpayers, so if one of you is a low rate taxpayer, then it could make more sense to do it in personal name. But again, it's dependent on everyone's personal circumstances.
Exactly that.
Yeah, amazing. I think it's been a really good sort of whistle-stop tour of personal versus limited company. And I think that's come into question again because the tax rates have changed. I think most people kind of were like, I don't know whether I'm going to do it this way or that way. But because the tax rates have changed, it's been really good to like revisit that and to understand exactly where people stand with that. If Prash, if people want to find you, I'll put your details in the comments of this podcast anyway. But if people want to find you, how can they get in touch with you?
Easiest way to get in touch with me is probably via YouTube or on Instagram, VPC Accountants. You've got my email address. Happy for you to put that in there.
Fabulous.
You can even put my mobile number in there as well if people want to contact me direct.
No
problem.
Amazing. Look, thanks so much. Like I said, we're not just doing this for the sexy stuff. The end of the day is, yes, we can get a car, electric vehicle for £50,000 and we'll only end up paying £400 on it. But the fact is we're trying to build portfolios for ourselves, for our families, to create security, to create financial freedom. And exactly like we just said, if you're looking to just continue to reinvest the money and it's not for you, it's for your kids, maybe a limited company might be more useful for you. On the other hand, if you're looking to actually withdraw the money from the company and use it yourself personally, then it could be the case that personal name might be the right route for you. But ultimately, you need to speak to someone like Prash, who is our resident accountant here at Lifestyle Property People. And we refer all of our clients to him because he, Prash, I shouldn't tell people this, but he does all of this, for our clients at least, he does all of this conversation, all of this advice, I suppose, free of charge. So if you're not our client, then sign up to be our client, then you can be in Prash's very good hands. Thanks so much for the chat. I really appreciate it. Is there any other final bits that you want to mention before we go?
No, I think that's pretty much everything.
Fabulous.
If anybody does have anything more specific, then yeah, feel free to get in touch.
Perfect. Thanks so much. Really appreciate it.
You're welcome. Thanks, Shiv.
Cheers.